This week for Meta, the story isn't just about AI, it's the colossal price tag that comes with it. The company is signing deals worth more than hundreds of billions of dollars to secure the hardware needed for its artificial intelligence ambitions. But with its own custom chip plans hitting a snag and the stock seeing a choppy month, is this the show of strength or a sign of a risky strategy? Why are investors both cheering the AI build-out and getting nervous about the bill? Welcome to TickerWatch News for Meta, Week 10, 2026. This week's episode explores the massive developments and news surrounding Meta platforms as the company resets its entire AI strategy, from its hardware supply chain and content deals to new product tests and emerging regulatory challenges. The stock snapshot. It was a mixed week for Meta's stock, reflecting the market's uncertainty. The stock saw a gain of about 2.6% over the last 7 days, closing around $653 on March 4th. However, looking back over the past month, the shares have seen a decline of roughly 8.8%. This performance comes as the broader tech sector has faced pressure, with investors weighing the long-term promise of AI against significant near-term spending and a volatile market. Year to date, the stock is roughly flat. Top news and headlines. The biggest story for Meta this week is a fundamental reset of its AI hardware strategy, moving aggressively toward a multi-vendor supply chain. The company announced a multi-year, multi-billion-dollar AI infrastructure partnership with AMD. The deal, valued at more than $100 billion, includes custom Instinct GPUs and gives Meta performance-based warrants that could convert into an equity stake in the chipmaker. This doesn't mean Meta is abandoning its primary supplier, though. The company also expanded its collaborations with NVIDIA and signed a high-value lease agreement reportedly worth billions for access to Google's advanced AI chips, known as Tensor Processing Units, or TPUs. This pivot to external suppliers comes as reports indicate Meta has canceled the development of its second-generation advanced AI chip following design setbacks. To power these massive AI systems, Meta is securing new sources of data. The company signed a multi-year content licensing agreement with News Corp, reportedly valued at up to $50 million annually. The deal gives Meta access to current and archived news content to help train its AI models and provide fresh information in its AI products. This follows similar previously announced deals with other major publishers. Meta is also beginning to reveal how it plans to monetize its AI investments. It's testing a new AI-driven shopping research feature within its Meta AI chatbot for some users in the United States. The tool responds to product queries with a carousel of recommendations, complete with images, pricing, and links to merchant websites, hinting at a future where AI assistants guide consumer spending. On the regulatory front, Meta is facing new rules. In response to pressure from antitrust regulators in the European Union and Brazil, the company will now allow rival AI chatbots to operate on its WhatsApp app, though it will charge a fee for the access. This decision came after regulators expressed concern that Meta was unfairly favoring its own AI tools on the popular messaging app. Back in the U.S., a House committee advanced a package of 12 bills aimed at improving online child safety, which could create new operational requirements for social media platforms like Facebook and Instagram. Finally, to house all this new hardware, Meta is expanding its physical data center footprint. The company is reportedly a potential tenant for a large data center site in Texas that was recently abandoned by Oracle and OpenAI. To power these energy-hungry facilities, Meta has signed long-term power purchase agreements to buy clean energy, including nuclear power from Vistra and solar power from 2 new large-scale projects in Texas. Market reaction and investor sentiment. Wall Street is sending mixed signals on Meta's strategy. A REIT downgraded the stock to neutral from buy, lowering its price target to $676. The firm cited concerns that Meta is lagging in AI monetization, while its investments in the space are surging, which could lead to margin declines. On the other hand, a report from Jefferies identified Meta as one of 24 tech companies that may be unjustly accused and undervalued by investors who are fearful of AI-driven disruption. institutional investors appear to be siding with the more optimistic view, despite some high-profile insider selling for tax and diversification purposes. One report noted a net institutional inflow of over $100 billion into Meta stock over the past 12 months. The sentiment seems to be a delicate balance between acknowledging the enormous long-term potential of AI and questioning the massive near-term cost to get there. Technically and fundamentally check in. From a technical perspective, after a powerful run-up, Meta's stock has been consolidating and trading sideways to lower for several months. One analyst noted that the $700 level is a key area of resistance, and a breakout above it could signal the start of the next rally. Fundamentally, the picture is complex. The company's valuation has reset, with the stock trading at a forward price-to-earnings ratio of around 22.5. While this is below its historical median, it remains at a premium to its industry. The core of the debate is whether the company's projected annual earnings growth of over 20% justifies the spending required to achieve it. That spending is significant. Meta is in the middle of a capital expenditure cycle expected to reach between $115 billion and $135 billion in 2026. This AI buildout is being funded through both strong operating cash flow and a notable increase in borrowing. Moody's recently affirmed Meta's strong credit rating, but cautioned that the elevated spending will likely limit free cash flow generation for the next 1 to 2 years. What to watch next week? Looking ahead, investors should watch for any executive commentary on the progress of these new AI hardware partnerships and the rollout of the AI shopping feature. Any further developments on the regulatory front, particularly regarding the child safety bills in the U.S. Congress, will also be a key area to monitor. Technically, the $700 level remains a key hurdle for the stock. The bull case for Meta is that this massive hardware and data investment allows it to rapidly develop and monetize new AI products, improving its core ad business and creating new revenue streams that far outweigh the initial cost. The bear case is that the AI arms race leads to continued uncontrolled spending that compresses margins without a clear or fast enough return. At the same time, regulatory challenges could slow down product rollouts and create new legal risks. The base case suggests Meta will continue its aggressive build-out, leading to choppy stock performance in the near term as the market weighs the heavy cost of investment against the long-term promise of superintelligence. That's all for this week's TickerWatch news for Meta. Thank you for listening. This podcast is for educational and informational purposes only and does not constitute financial advice. Remember to subscribe and share the episode.